Welcome to TheoTRADE. This is Don Kaufman. It's October 13th, 2023. We are just moments after the cash close here on this Friday the 13th. S&P's closing out the week lower. Nasdaq taking a pretty good hit to the tune of about 1.3%. Got to tell you, the Nasdaq has started to cave under some of the geopolitical risk. But on this weekend's update, we're going to go much deeper because it's the risk metrics that have really come alive and now is the cause for concern. Allow me to explain. All right, let's get right into it. First and foremost, I'm going to bring up the obvious. If you take a look at the SPX, the mother of all products, right? We're just taking a look at the S&P on the week. This central line right here, that's where the week started. Where did the week end? Actually slightly higher. One of the first points I want to make is like, okay, so net, we're talking about like the Nasdaq and it's caving under geopolitical risk and like everything that we've been through throughout the course of this week, the S&Ps will still actually end the week and have ended the week ever so slightly higher, okay? And that's critically important. However, at the same time I'm saying that, and again, I'm going to jump over to the QQQ right now, right? So let's come over to the NASDAQ and let's look at its auto expected moves. The NASDAQ will also eke out the most mild of gains on the week. All right, for the most part, it's massively unchanged. So what's the cause for concern? Again, it's the risk metrics. What we really want to focus on in this weekend's update is really throughout the course of some of the geopolitical, events that have unfolded, we hadn't seen a big bump in volatility. We're going to look obviously at the VIX, which we're looking at right now, and the VIX actually hits north of the 20 handle today, and it's right up against, some of its recent highs. Like this is about all the VIX has done in that 19 or 20 region since really all the way back in like May, June. It kind of peaked out over there. If you want to look back the last time things really got, crazy, you got to go all the way back to like March, a little bit in April, of this year. So we are starting to see some formidable amounts of volatility. But I'm going to go much deeper than just that. Look, it's not, I don't just look at VIX and go, volatility's up, because that's just not going to do it for me. It's everywhere you look in the marketplace right now is pointing to fairly significant, risk. And as I said, it's not about what the market did this past week. It's going to be what we're looking at next week. And obviously, we are a geopolitical hotbed of risk right now. But what I'd like to portray, again, in this weekend's update is really your understanding that the risk metrics that I look at, like any measurement of risk that I look at, is pointing, towards a very horrendous risk reward. And what I'm trying to quite simply imply by that, and I'm just going to come right out with it, right now in a marketplace, of course, you have upside potential. The downside risks are phenomenally large, specifically inside of the NASDAQ. And it's rare that I come out, on any of these weekend updates or any of the videos that I do, and immediately start to disseminate like risk reward and so forth. But this is, there's not a lot of parallels to look at in a marketplace that are as clear and concise as present risk in this market. And what I mean by parallels, like now I can look back at, lots of geopolitical events and so forth, and I can't draw too many parallels back to, and I've been through a lot of geopolitical risk. This one is very extreme at this point in terms of those risk measurements. Again, let's get into it. As I say, the NASDAQ today kind of caved under some of the geopolitical risk. I think this was less about geopolitics today and just more about the market effectively resolving to the downside. Meanwhile, let's get to the meat of this. So as I said, risk metrics come alive. And it was predominantly today. I'll start, okay, with the cleanest of them all, which is VIX. Throughout the course of this week, ironically, VIX is actually slipping pop right back to the upside here. It just kind of felt like, look, nobody wanted to go home this weekend. Okay. You don't know what's going to happen on Saturday, Sunday, even this evening. Okay. Nobody wanted to go home long, but the market didn't get crushed. Instead, it looks like trade reached heavily for risk mitigation. Obviously, again, you see VIX to the upside, but I look at much more of a definitive measurement. Okay, in my estimation, I look at volatility futures, and I do not look at the chart on volatility futures. I look at what's termed contango and or backwardation. And in very simple terms, we're home. Okay, what does that really mean? Yeah, we're actually in, if you will, and we closed this marketplace, okay, on this Friday the 13th. Ooh, scary. Anyway, we actually closed in backwardation. And what that implies is November is starting to exceed December, which in effect says, like, look, the sell side activity in the marketplace clearly was a non-event. And the S&Ps, as I said a moment ago, closed up on the week. So why the cause for concern? Because we're actually flipped. And it actually implies that risk in the next, and I'll give you a very definitive answer for this, but risk in the next 33 days is actually larger than risk of the next 68 days. Doesn't matter what you think, doesn't matter what you know one thing. You're in the throes of volatility right here, right now. Okay, the risk is bigger than it is in the future. And that's really weird to say because given 68 days, a hell of a lot can happen. But what this market's saying is no, the risk is right in front of it. It's right here. Okay, we're going to get, again, the biggest brunt of risk is coming in the next 33 days. In 68 days, we're going to revert back down to some degree. And that's exactly what volatility futures happen to be proclaiming at this point in time. So again, it's a little bit of like trader beware. And you're looking right now, okay, at these are volatility future curves. And it's very strange if you've never really, spent any time looking at these, but it's today versus, for instance, this is like June 13th versus October 13th, and we're flipped over into a backwardation. With that being said, let's move past volatility futures. Like I think people get it. You're in backwardation. It can be a very dangerous time in a marketplace. Moreover, when I talk about hedging activity, what I'm actually referencing is traders are actually running, okay, to volatility instruments to mitigate risk. One of the volatility instruments they're running to is VVIX. Okay, look, the VVIX is actually not the instrument that's traded. VVIX is the volatility of VIX, and the volatility of VIX is up by 17%. So what that entails is that the VIX itself, okay, is getting all kinds of squirrely. It's the options in VIX, okay, were traded extensively today. So how extensive was it? All right, survey says, look, this is the VIX. This is not, like, Joe's tree cutting service stock, okay? It's definitely not Birkenstock or any garbage like that. It's the VIX. I mean, the VIX trades almost 7 times the normal daily option volume versus the previous 5 days. Pay attention. Thing did almost 2.7 million contracts. It's on right now, okay? Trade ran to VIX. So if all hell breaks loose next week in this marketplace, mark my words, professionals, they've mitigated that risk, okay? There is no other, okay, concise explanation for VVIX being up 17% and for the size of the trade that you're seeing in VIX right now. It's nothing less than phenomenally large. So, okay, in addition to it, bonds. Bonds have been an outright horrendous crash to the downside. Well, until really, okay, they started to be bought, I believe, and this is the one that's probably up for debate. Look, this started as a bid back under bonds, right? Huge crash, bid back under bonds. Today, though, this actually looks like it's hedging activity. The trade is actually running out and buying bonds to reduce exposure because everything else is about, reducing exposure. Everything from vol futures to VVIX, bonds are bid. The other aspect that really, really sat with me not so well here, look at the size of the trade in gold. Okay. Gold up some $3. And normally you're like, whatever, man. Gold moved up. Okay, sorry, 3%. Did I say $3? 3% on a $60 move. Pardon, okay, my percentages on that one. The volume's huge in there. The thing that really bothered me, though, more than anything about the gold trade is that the gold trade rallied with the dollar effectively higher. Dollar's been higher, considerably higher, over the last two trading sessions. Started to fade, popped right back. It's almost back into this absolutely unequivocal perfect channel. Just an absolute perfect channel. Anyway, the dollar's higher, and it didn't matter. Gold rallied, and that's the largest rally we've seen in gold really in recent history. You can come back here and you can look at this all you want, but the dollar was actually selling off over here, pushing gold maybe a little bit higher. Okay, again, this is the largest rally we've seen in recent history, which is, I'll reiterate once again, all of these are pointing towards very considerable, instability to the equity market that's forthcoming. Frankly, as I said, I think that the equity market held up incredibly well. Yeah, the Nasdaq started to cave today. It's the first time we've seen that, which I'm actually going to bring up right now. Looking at Nasdaq, as I said, the Nasdaq caved under geopolitical risk. Quite frankly, I just don't think it's about geopolitical risk. The Nasdaq is the sector that needs to get hit if the market's going to go down. And what I want you to understand is that you think to yourself, well, how can Microsoft be influenced by some of the geopolitical risk? It's hard to kind of draw that conclusion. You need to stop drawing that conclusion and start understanding that if trade starts selling the S&Ps, let's just say traders start coming out, they start selling the S&P futures. I'm sorry, they're going to attack, at risk of sounding extraordinarily bearish, you're going to see big tech get annihilated on that one. And why? There's nothing else to sell to bring markets down, and this is where, we can spend all kinds of time looking over at the financials. They've been brutalized to some degree. The financials are down 3%. We talked about energy. Energy at this point has to be construed as its own animal. Okay. Why? Well, because energy is actually caught up in the geopolitics over here, which the energy sector effectively held the market together throughout the course of today. What I'm trying to prepare you guys for, is the fact that, again, when it comes to technology, this is one of the first days, period, that we have seen correlation specifically and expressly in what we term the Magnificent Seven, the Microsoft, the Apple, the Amazon, the Google, Meta, and Tesla, and NVIDIA. They took a hit across the board. And the cause for concern right now is if that NASDAQ really is going to continue to cave under geopolitical risk. Again, it's hard to draw the conclusion of like Microsoft, as I said, or NVIDIA versus what's going on in the Middle East. But at the same time, remove yourself and understand. Trade comes in and sells the S&Ps. They're going to smack technology. Why? Because the other sectors have already taken a hit. And because energy is its own animal, as I said at this point. Energy, ironically, has held the markets together today. I mean, energy's up 2.2%, and that's the energy services, energy sector. Meanwhile, again, oil, it's a fairly vicious move to the upside. Look, we've all seen worse in oil. Again, lately we've seen worse in oil, and it could get a lot worse in oil. But again, push energy aside, all things being equal, they're going to hit a sector. It has to be the NASDAQ. It has to be tech. And that needs to be your focus. That's why I entitled this weekend's update, The NASDAQ Caves Under Geopolitical Risk, because quite frankly, NASDAQ hasn't really caved, not yet. But it will if that risk comes to fruition. And that's what I want you guys to understand, about this marketplace. All right, inflationary indications, everything from PPI had come out this week. That fairly hot report. We could talk about CPI till we're blue in the face. Look, the bottom line is here in the US, inflation, seems to be making just a little bit of a comeback. that'll be cause for concern. The cause for concern with inflation is, yeah, CPI and PPI, right, take it with a grain of salt because there's more data to come out. But that coupled with the possibility that oil could spike, we've all heard crazy numbers like oil can go to $150 a barrel. Of course it could. Okay, it's been there before. Why wouldn't it do it again? But with all due respect, I think it's much more about the inflationary pressure of an oil that would rally, coupled with a dollar that has been ripping to the upside, which is exporting inflation. One other aspect that will kind of loom a little bit this next week, the financials. So financials had earnings today, okay? To get very specific, you look at stuff like what? JP Morgan. JP Morgan was like a 2 standard deviation move, completely faded, almost gave back the entire move. Bank of America, okay? It doesn't have its earnings until next week, but flipped over and faded on the day. Wells Fargo, okay, faded on the day. Point that I want to make is earnings right now are almost like being excluded. It didn't make a difference. The numbers didn't make a difference. The financials still came back down. Meanwhile, you're going to start to hear from what? Tesla next week, which also faded the last 3 days. Nothing huge, but you are going to have to deal, okay, with one of the pivotal stocks inside of Nasdaq going through earnings. Meanwhile, I know everybody loves to talk about Netflix. Netflix is not going to move the Nasdaq. Tesla moved the Nasdaq. But again, some of the tech earnings, and I would definitely put Tesla under tech earnings because it can influence, well, the entire tech sector, of course, in the Nasdaq. This is one we're going to have to watch, and we're especially going to have to watch it because Tesla is starting to get a little heated in terms of its expected move. We'll see if that comes up a bit more. All right, so fading on strong earnings, okay? Basically what you're saying is discount some of the earnings announcements, focus what's going on in the broader market. Remember that if risk is going to come to fruition, it's coming into tech. And I got to tell you right now, people, look, I am geared for that. Like, bring it. I'm short everything from NVIDIA to Microsoft. Okay, I've even got JP Morgan. It left a little bit of a mark today, but I am short most of the an Apple and Amazon. Oh my, and even a little bit of Google. I'm short the big boys of tech, which worked extraordinarily well today. We'll see what next week brings. Last, but definitely not least, we look at the SPX as we do each and every week, right? The SPX, and we just came off of a week where we spent the majority of, again, this geopolitical hotbed of risk higher on the week. How much higher? Right here, right? This is, again, where the week started. I say this. Let's put a number to it. The week in the SPX started roughly at 43.08. The upper edge of the expected move was about 43.85. It's a hit. We hit it on Tuesday. We hit it on Thursday. We faded today. Faded just basically means sold off. But the expected move, okay, this week was about $76, as denoted right here. Why do I bring up the $76? Okay, because now here we are, just about 28 minutes after the cash close. This is the definitive expected move for next week, is bumped up to about $90. I'm just going to throw it out here. That's big league. Okay, that is the big leagues over there. They're throwing 90 mile an hour fastballs at your head at this point. Be aware. So not only do we have volatility, okay, in a backwardation, we got VVIX rocking. All right, you got gold flying to the upside. Dogs and cats living together. You've now got an elevated SPX volatility, which is just indicative of one thing. Get ready to rock next week. Look, you're going to see lots of movement, right? Big bids under the marketplace could be faded, number of reversals. I mean, today was just weird because the advanced decline line's not bad, but the S&Ps got beaten up. Can you imagine what this would have looked like if we correlated, if all 100 stocks were down at one time? Okay, the market, okay, again, fared extraordinarily well given the geopolitical risk it faced. However, remember, that Nasdaq, that's what caves if this risk gets any deeper. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.